Hello and welcome to the Mutual Fund Show on NDTV Profit. I'm your host, Neeraj Shah. As always, we'll try and get you the most informative or actionable insights into the space of mutual fund investing. Now, today we've chosen a topic which is probably applicable to every single investor. In fact, I will say it's applicable to every single investor because a lot of us, if not all, due to various factors, might not have an exact handle on the number of mutual funds that we have in our mutual fund portfolio. And the topic that we've chosen today, or the question that we're asking our guest today, is what is the optimum number of mutual funds that you should have in your portfolio? Or if I can invert the problem, should you not have more funds in your mutual fund portfolio? Let's pose that question and try and get the insights from two experts, Rohin Pagdiwala, CFP and founder of Pagdiwala Investments, and Karthik Shah, founder of MMY Investments. Gentlemen, both of you, thank you so much for taking the time out and being with us. Great having both of you. Karthik, you've spoken about this before. Let's start off with how do you think about this being a problem? So
I've come across various portfolios of various investors where I've seen more than 35 to 45 mutual fund schemes. And on asking why those schemes are there in that particular portfolio, they don't just have an answer. Because many a times, so I've identified two major causes. One is blindly subscribing to any and every NFO which comes. And secondly, many DIY investors, what they do is every year they try and include the top rated funds, which change every year. So over a period of 5 to 6 years, they have so many mutual fund schemes. And due to which what happens is sometimes it gets concentrated on a particular market cap. So let's say if it's concentrated more on the large cap side, then they miss out on the mid cap and small cap rally. Or at times it is also concentrated on a particular style of investing. So more of growth funds or more of value funds. So there is no technique as to how those funds actually ended up in that place.
Sure.
So when you have to, analyze those funds, and when you have to see that whether you want to add a particular new fund scheme, no thought goes behind it. And that is where I feel it's a big problem, because at times there are so many laggards in that portfolio that they drive down the performance.
Okay. Rohin, is too many funds a bad thing?
I think in general, yes. In my mind, maybe about 7 to 10 funds or 7 to 12 funds is enough for a portfolio. And like Karthik said, there's a lot of investors who have a lot of funds, apart from it being an operational nuisance, because every fund that you have, then you have to ensure that the nominees are updated, folio details are in place, etc., etc. But from a performance point of view, what happens is the more the funds you are, the more you're tending towards the performance of an index, right? Because more funds means more stocks or more number of holdings, and therefore effectively you're buying an index, so you might as well buy an index fund which is at a lower cost. So I think there is a lot of negatives of having too many funds. Largely legacy issues, like Karthik was saying, too many NFOs, too many people chasing returns, too many operational reasons that they have things. Somebody wants holding patterns to be particular, me and my wife, me and my daughter, etc., etc. So there's a variety of reasons for that. But yeah, 7 to 10 is, I think, enough for most portfolios.
Okay. How have you arrived at this number, 7 to 9 or 7 to 10? What have you?
It's not, there's no specific data or science behind it, but there is a practical approach to it, which is, let's say your asset, depending on the asset allocation that you have, my recommendation or my preference is to have 2-3 funds in each category. So let's say you have equity large cap or equity flexi cap as one category in equity. Then I think 2-3 funds in that category are enough. Reason being, don't want to have one because you don't want to have a style bias of a particular AMC. You don't want to have to carry the AMC risk. And therefore you need 2-3. But 2-3 is generally enough to get you the diversification that you need and eliminate any kind of other risks.
Okay.
And therefore 2-3 funds in each category. Generally you'll have 3 or 4 categories. Flexi cap being the primary one, multi cap being the other, and maybe a small and a mid a little bit. That should be enough, that 7-10 should be enough to cover that.
So this we are, sorry, and then I'll come to Karthik for the same question, but this you're talking on only about the equity fund side.
Equity side,
So you're saying about 7 to 10 funds on the equity side, and then you add a layer of debt to it or balance
Correct.
advantage.
You can add 2-3 more funds on the debt side if debt is part of the allocation mix.
Okay, yeah. Assuming that debt is a part of an allocation mix in an ideal portfolio.
Correct.
So you're saying between 7 to 14 could be an ideal number according to you?
On an overall basis, yes.
On an overall basis, yes. Okay, Karthik, your answer could be different, but I would love to understand what do you think is the ideal number of funds in a portfolio?
So I feel, rather than first answering this question, I feel that when you identify a new fund which you want in your portfolio, you need to look at if there is a portfolio overlap happening. So as per SEBI guidelines, there are 36 different categories.
Right.
So we cannot have fingers in all the pie. So many a times people do one large cap, one small cap, one mid cap, one large and mid cap, one flexi cap, and they just keep on adding. So I feel if you take a particular scheme and check within of the portfolio overlap within a particular category, in equity side, 6 to 8 funds give you a good amount of universe of stocks. Maybe passive funds on the large cap side, maybe 1 or 2 flexi cap funds with different styles, which invest across market caps, small cap one, mid cap one fund, and one international fund. Pre-April 2023, I would have recommended going for a NASDAQ 100 or S&P 500, but because of the taxation issue, there are funds internally which invest around 65% in domestic equities and they invest around 20 to 25% in international. So that way you save on taxes also. And if you can time the entry and exit, now this is for a seasoned investor, then you can go for a thematic fund. But as he rightly said, you start off with an asset allocation. So for your short-term goals, you go for debt funds. For your medium-term goals, hybrid funds and maybe passive funds. And for your long-term goals, active equity funds.
Okay. And I want to talk about one core aspect as well, which is the core and the satellite part. But just before I get there, Karthik, can I ask you, why don't you design a portfolio for us right now? Let's say somebody starting from scratch wants to invest 10,000 rupees or 20,000 rupees in an SIP fashion in a portfolio, building out from scratch. How would you build it out? What flexi cap, what passive, what have you?
So if I'm assuming that he's in his 20s and
he or
she is in 20s and he or she is just starting out. So I would recommend one fund for a passive index fund, maybe a Nifty 50 or a Nifty 100, 2 flexi caps, and one small cap fund. This would be good enough. So 4 funds to start off with.
Okay.
And then
on the equity side.
On the equity side. Because I'm assuming, so he is investing for the growth. So right now, because he's starting early, debt can be very small portion of his portfolio. If at all he has to add a debt, he can go for a hybrid fund to save on taxation, a balance advantage fund or an equity savings fund. But other than that, because he is starting in his 20s, he or her, he should invest for the long term in equities more.
Okay. And any names, Karthik? I mean, these need not be exhaustive list because you could be maybe liking 5 or 6 flexi cap funds, but just for somebody who's actually looking at this and trying to think of what names come to mind of
so
of
for
these
flexi
categories.
cap, Parag Parikh flexi cap is a good fund. Canara Robeco flexi cap also can be added to it. For the mid cap space, Kotak Emerging Equities or Nippon India Growth Fund. For the small cap, Nippon India Small Cap is a good fund. In Parag Parikh Flexi, we have a 14 to 15% internally which gets invested in international equities. If someone wants more exposure to international equities, then there is a Kotak Pioneer Fund also, which has some portion which automatically gets invested in international equities. But these are good funds, and one index fund. It can be Nifty 50 or a Sensex fund or a Nifty 100 fund.
Got it. Now, viewers, keep in mind, these funds, you should please research them yourselves. Look at the overlaps, if you will. I'm guessing when Karthik has said there might not be overlaps, but please do for that check as well. And if you have a financial advisor, please consult the financial advisor, but definitely ask the financial advisor about the number of funds in your portfolio. Now, Rohin, the same question to you. If you can design one portfolio for us right now, for somebody again who is, let's say, 20 or 30, what have you, and she or he is wanting to start the portfolio from scratch, you can do it whether this way or maybe, as you had said to me in the past in one of the shows, a core and a satellite portfolio.
Sure. So yeah, I'm starting with the assumption that we're okay to do 100% equity in the portfolio because he's a young person, so he'll have the risk-taking ability. I'd have a bulk of the portfolio, which is the core part, and core being 80% of the portfolio. A bulk of that in flexi cap and multi-cap funds. I wouldn't really feel the need to go into small and mid-cap funds specifically because they are multi-cap funds in effect have 25% minimum small cap and 25% minimum mid-cap. So multi-caps are an easier way to get exposure to small and mid-caps. Plus the advantage that the fund manager can shift monies within the fund as market dynamics change. So from the 80% core, I would have about 30 to 40% in multi-caps and the remaining 40% in flexi caps.
Okay, no large cap. FlexiCap kind of does the job
yeah,
of the large
FlexiCap
cap.
does that. And again, I would stay away from funds which have a large cap bias in their FlexiCap strategy.
Okay, so what names would come in?
So
example,
Quant FlexiCap, maybe an HDFC FlexiCap, JM FlexiCap, which is doing extremely well right now. Even though it's a small AMC, it's doing extremely well. So those would be some of the FlexiCap funds. In the multi-cap space, again, Quant Active, Kotak Multicap, and SBI Multicap, IPO Multicap are all doing well. So,
Okay.
so some of those funds. The interesting part is the satellite side of the portfolio, and the satellite portion should be viewed as a tactical 2-3 year horizon kind of portfolio, which you use to generate a little bit of alpha for the investor. So you could, let's say, put that money in momentum funds, like an index fund from Motilal Oswal, which is a Nifty 200 Momentum 30 index fund, which is doing extremely well. Now those funds, or you could do sectoral funds as well. So if you feel positive on healthcare or pharma, then a healthcare fund. If you feel positive on infrastructure, then an infrastructure fund. So I've recommended some of these funds to my clients, Quant Healthcare, particularly Tata Infrastructure. So those are satellite allocations. Your core part remains long-term oriented. The satellite part is more 2-3 year horizon.
Got it. But viewers, I think the one thing that comes out of this conversation with both our guests, and I know we're short on time, but one thing that comes out is that if you look at the core portfolio or the main portfolio that they're building out, if you're starting off from scratch, and assume that you're starting off from scratch, their number of funds did not even exceed 7. So the limited point is, if your mutual fund portfolio has, in terms of the number of funds, a number which exceeds 15, 20, 25, or maybe even more, and a lot of you might have that, please go back and examine that portfolio. Examine the need for having so many funds in your portfolio, and if there is no need, then for multiple things that both our experts suggested at the start of the show as to why this could be happening and why it's a problem, try and see if you can realign your portfolio to a smaller number. Final thoughts, 30 seconds each.
I want to just add that when you start to declutter your portfolio, see the performance of the funds vis-a-vis the benchmark as well as the peers. And when they are underperforming for 3 to 4 quarters at a stretch, then it's the right time to exit them. But also see the taxability. So if you are able to redeem over a period of 2 financial years, so in 1 financial year you get long-term capital gain exemption up to 1 lakh rupees. So if you are able to phase it in 2 financial years, you can save on taxes also.
Yeah, but this exemption is only for mutual funds or across?
No, across equities.
Across equities. Across equities, 1 lakh rupees. Rohin, final thoughts?
Similar thought. If you're revamping your portfolio, if you've got too many schemes, then A, consult an advisor, preferably. B, keep in mind the taxation aspect, because there is a tax impact of exiting old funds. You must do it, but you may want to do it gradually.
Okay. Fair point. Gentlemen, both of you, thank you so much for taking the time out and being with us on the Mutual Fund Show. Really, really appreciate your time. And viewers, I hope this was informative. It certainly was informative for me. But out of time completely on this leg of the Mutual Fund Show. Stay tuned to NDTV Profit for fresh news and updates.